all of the factors that people have been buying gold, the central banks buying gold to diversify out of a dollar in the face of dollar weaponization, I think at the minimum we can say that hasn't gone away under the current administration. They didn't start it, of course, but when you're threatening tariffs on the BRIC countries because, if you go against us, we're going to tariff you, that's all wildly bullish for gold.
This precious metals bull market is following a path that I have observed in my life 3 times before. I've seen transition go from the metal to the best of the best. After it goes from the best of the best, it goes to the best of the rest. We are in a gold and gold equities bull market now. We're not waiting for it. We're here.
Gold continues its bullish trend in 2025, supported by economic uncertainty and shifting monetary policy. Adrian Day, CEO of Adrian Day Asset Management, views the evolving landscape as favorable for gold, seeing any short-term dips as opportunities to buy both bullion and mining stocks. Following record highs in 2024, gold has already reached new peaks in early 2025, with momentum fueled by U.S. interest rates, dollar movements, geopolitical tensions, and the recent presidential election, trends likely to carry through into 2026. Central banks remain the dominant force in gold demand, demonstrating consistent purchasing patterns despite occasional pauses. Day notes that following a brief slowdown months ago, central banks have resumed aggressive accumulation, with China leading this trend through 8 consecutive months of purchases after a temporary halt. This reinforces the country's pivotal role in global gold markets. Institutional demand shows little sign of weakening, with forecasts projecting approximately 900 tons of central bank purchases in 2025. This sustained buying reflects current macroeconomic conditions and anticipated growth in investor holdings, particularly through ETFs, as well as continued Chinese market participation. J.P. Morgan research indicates that, after 3 consecutive years of central bank purchases exceeding 1,000 tons, this structural buying trend is expected to persist through 2025 and 2026. China's People's Bank of China exemplifies this commitment, adding 70,000 troy ounces in June 2025 alone, the 8th consecutive month of accumulation according to Bloomberg News. Since November 2024, China's reserves have increased by 1.1 million troy ounces, equivalent to approximately 34.2 tons. This pattern underscores China's strategic positioning and its significant impact on global gold dynamics. Before we dive in, make sure to like, share, and subscribe to our channel. Stay connected by hitting the subscribe button and turning on the notification bell. You won't want to miss any of our latest updates.
We really haven't had a proper correction in gold. The 3,500 was a bit of a spike. I know it did get there, it's real, but we really haven't had a proper pullback in gold for the last 3 years. If you get, what are they talking about? Is it 8 or is it 10 trade deals going to be announced very, very soon? Or was it 7 or was it 11 or was that yesterday or was that this morning? But anyway, they're talking about a bunch. If you get a bunch of trade deals announced with important partners, like Japan and Korea, and the EU has said now that we're close to a deal. So if you get trade deals announced, if you get some more reasonably positive news on the economy, so that interest rates are not going to be cut again. If you get some more Arab countries, particularly, say, Saudi Arabia, decide to join the Abraham Accords. They've been there's a lot of talk about that right now. I think that's a confluence of factors that could see a little bit of a steam taken out of demand for gold and cause a bit of a pullback. If we see that over the next, say, 6 weeks, month or 6 weeks, I would see that as an incredible buying opportunity. And it may not even happen, but if you look out 6 months a year, it's difficult for me to be more bullish than I am, and that itself is a dangerous thing, I realize. But all of the factors that people have been buying gold, the central banks buying gold to diversify out of a dollar in the face of dollar weaponization, I think at the minimum we can say that hasn't gone away under the current administration. They didn't start it, of course. But when you're threatening tariffs on the BRIC countries because, if you go against us, we're going to tariff you, that's all wildly bullish for gold. Is Brazil going to say, oh, we're so sorry, Mr. President, let's go buy some of your treasuries? No. They're going to say, let's dump your treasuries and buy as much gold as we can. So all of these factors, and then on top of that, you've got the changing economic thing that we talked about, which is going to get more people interested in gold. So any pullback would be a buying opportunity in my mind.
For gold and the gold stocks, I imagine.
Gold stocks as well, yeah. The gold stocks will really take off. I mean, we're already beginning to see it. I mean, the gold stocks have done well, and it's incredible. But when you see the XAU or the GDX up, 55% or whatever in the last year, and that's in the face of outflows from the GDX, from the GDXJ, that's pretty astonishing. So can you imagine what's going to happen when ordinary investors, and by ordinary, I don't mean just small investors, I mean ordinary investors, that's including money managers, registered investment advisors, and so on, start to buy gold? And we're just beginning to see that. The fact that silver's outperformed gold this year, the fact that the GDXJ has outperformed the GDX, even though the GDX J isn't really juniors, but nonetheless, the somewhat smaller stocks are outperforming the bigger stocks. These are all signs of interest from ordinary, what I'll call ordinary investors, from retail investors. A few months ago, we did have a bit of a pause from several, or slowdown in the buying from several of the central banks. But no, the central banks are still far and away the largest driver. But of course, it's all what happens at the margin. If they used to buy X and now they buy X minus 10, that matters. But the central banks are still buying. China, as you know, in the latest numbers that came out yesterday, China's still buying. That's the 8th month in a row that they've been buying, because they paused last fall. So they're still the main buyer. Where we've seen a bit of a change recently, or the biggest change recently, is with the non-official Chinese sector. That buying, which shot up in the spring, has subsided. Early spring has subsided. I don't know that that's permanent. It's probably coming back. But the next move, it seems to me, is with North American investors, not the Ray Dalios and Bill Druckenmullers and so on, but ordinary, not just retail investors, but investors, family offices, small institutions, investment advisors telling their clients, money managers, etc., all of that. So I think the next leg is going to be the North American investors who've really been out of this market, as you know.
Veteran resource investor Rick Rule, former head of Sprott U.S. Holdings, believes the long-anticipated shift in the gold market has materialized, with rising prices, increased producer cash flows, and a strong market response confirming the arrival of the bull market. Gold prices reached approximately $3,360 per ounce on Tuesday, driven by concerns over President Donald Trump's tariff policies and their potential economic impact, which reinforced the metal's safe haven appeal amid ongoing trade uncertainty. Despite historical skepticism toward gold, Rule notes that recent strong performance has renewed investor interest. Addressing concerns about rally sustainability, he references the 1970s when declining U.S. dollar purchasing power drove gold to rise 30-fold, suggesting the current environment offers similar long-term potential. This historical precedent supports expectations for continued appreciation amid current economic conditions. Gold's fundamental advantages as a store of value remain intact during periods of declining purchasing power. Unlike fiat currencies, which are subject to unlimited printing, gold's limited supply and universal recognition provide superior wealth preservation capabilities. The precious metal's scarcity ensures that its value is maintained even as paper currencies lose purchasing power due to excessive money printing and fiscal mismanagement. Let's get back to the video.
I think Grant Williams' talk today did a very good job suggesting that the circumstance that we existed in the period, say, 1980 to 2020, while it was very pleasant, is over. That the demographic boom that we enjoyed is becoming a bust as my generation dies, literally. That the period of lower interest rates and U.S. dollar hegemony is over. Nobody, I think, is suggesting that the world is going to come to an end, but we are all suggesting that the set of circumstances that we enjoyed for 40 years have changed. And we're going to have to adapt to that change. Certainly, one of the ramifications of that, one of the ramifications of a weaker U.S. dollar, in absolute sense, maybe not a relative sense, but in an absolute sense, is I think there's a consensus around the fact that gold will continue to do well. There has been skepticism about the gold price on and off for a very long time. People say to me now, gold's done very well of late. Do you think that's over? And I try to point out to them that in the decade of the 1970s, the last time that the US dollar enjoyed, if that's the right phrase, a precipitous decline in purchasing power, that the gold price ran 30-fold. And I think one conclusion that came out of that panel is that although everybody had different interpretations of the problem, interestingly, everybody had the same solution. The theme that we talked about last year, we said it was inevitable, but not necessarily imminent. Now it's imminent. The increase in the gold price, the follow-through from the increase in the bullion price to the increase in free cash flow among producers and the market reception to that means that now the change isn't merely inevitable. It has to happen. Now it's happening. Now we're in it. This precious metals bull market is following a path that I have observed in my life 3 times before. I've seen transition go from the metal to the best of the best. After it goes from the best of the best, it goes to the best of the rest. We are in a gold and gold equities bull market now. We're not waiting for it. We're here. I'm not sure that those people in government who I have met are competent to have a master plan. My suspicion is that they take advantage of trends in motion to consolidate their own power. Very different than Jim's belief. I don't know why you would work really hard to devalue the dollar, although certainly Trump did say that a weaker dollar was good for some aspects of the U.S. economy. I'm not sure that you have to work real hard to cause the purchasing power of the dollar to decline. Given the aggregate levels of debt in society, it seems to me that the only way that you honor the nominal value of our obligations, which for entitlements alone exceed $100 trillion, without devaluing the purchasing power. You honor the nominal obligation of Social Security to an old geezer like me by continuing to pay him $4,000 a month or whatever it is they pay, but by devaluing the dollar. In other words, $4,000 buys you 10 years from now what $1,000 did now. We did that in the decade of the 70s, Danielle. I understand that you weren't there. I was. Over the period of the 1970s, according to the Office of Management and Budget, the purchasing power of the US dollar in an absolute sense, not relative to the Canadian dollar or the pound, but in an absolute sense, the purchasing power of the dollar declined by 75%. No, my friend Doug Hasey once said that the dollar's an I owe you nothing. The euro, because of 13 participants, is a who owes you nothing. And the BRICS are nobody owes you anything. The idea that you develop an overarching convertible currency out of a conjunction of non-convertible, illiquid securities is silly. The other thing is that the BRICS nations, while they don't trust us, trust each other a little less than they trust us. I learned that when I was selling Sprout products to global wealth funds, sovereign wealth funds. I'd ask them, why do you use U.S. Treasury securities? They seem like a lie. And I remember an Asian counterparty saying to me, yes, but a deep and liquid lie. And I said, do you trust us? He said, oh no, but we trust you more than we trust each other.
As global tensions rise and economic indicators remain volatile, gold continues to assert its role as a dependable store of value. Investors around the world are closely watching these developments, reassessing their portfolios in light of growing uncertainty. The gold market's strong performance in 2024, posting an annual gain of over 27%, the highest since 2010, highlights its resilience in the face of economic headwinds. This momentum reflects gold's ability to weather financial instability and maintain investor confidence. Amid ongoing geopolitical risks, shifting monetary policies, and sustained central bank buying, gold remains a cornerstone for those seeking long-term security. With increasing demand from both institutional and retail investors, gold is well-positioned to continue benefiting from the evolving global landscape. Could gold be entering a powerful new uptrend as global uncertainty rises? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Only 2.3% have subscribed, so hit the bell icon and turn on notifications to stay updated. Your support enables us to continue delivering the latest market insights to you and the broader community.